Welcome back. You with us here on Opening Fire. We've got the market, which is looking, flattish, not very much happening at all. 8450 odd is where the Nifty is. That's about 15, 16 odd points lower. Navneet Munot is with us right now. He's Chief Investment Officer at SBI Mutual Fund. Navneet, good morning. Good to have you with us here. It's been a while. Prashant this side. Navneet, so is the market looking, the market direction in the near to medium term looking clear to you? Or it's a little muddy right now?
So overall, we have seen a decent resilience in the market amidst the global volatility, which was caused earlier by the events in the Europe, then the recent events in China, the big crash that we have seen in the equities market there, then the currency depreciation. But overall, I think Indian markets have been holding well. FIs have turned net sellers in last few days, but I think the flows from the domestic markets are providing a cushion to the market. And I think despite the disruption in the parliament where legislative reforms could not happen, I think overall by and large markets have taken them into their stride and looking at a longer picture. So I think this phase of consolidation continues for some more time. And over a period of time in next few months, as the expectations on corporate earnings undergo a change, I think over a period of time, markets would start the new leg of bull run in a couple of months' time. But till such time, I think we see this period of consolidation. Next month, I think we'll also have most likely a policy normalization beginning in US Federal Reserve, so that will have some impact on the sentiments. But otherwise, I think India is increasingly looking relatively better from a global investor's point of view. And I think domestic investors continue to maintain their faith.
By the end of the year, Navneet, do you think the market can be 10% higher or 10% lower? What are the odds?
End of the year, you mean the financial year end? I think, yeah, I think possibly around 10% higher.
Calendar year.
And next 2 or 3 months, it's difficult to make a projection on next 2 or 3 months. I think there will be some volatility around the policy normalization in US. But yeah, even otherwise, I think as we move towards December and the earnings expectations for next year, FY17 and then FY18, undergo a change, I think there would be some upside. Also, I think the legislative reforms could not happen in this session, but I'm sure government would be working on some alternative strategy to get that done. I think they are still sounding confident about the GST implementation from April 16, but I think that will also be made up through a lot more executive action, the ones that we have seen in last couple of days. I think that is likely to continue, and that will also support the market.
Yeah, okay. So, do you think the worries are mostly global and they are serious worries, Navneet?
So some of these, I think the events in China clearly shows the underlying vulnerability in that economy. The growth, I think it looks like even a 7% is going to be difficult for them to manage. So an economy which was trying to do a soft landing with a country that has grown at 10% for a long time, trying to grow at 7%. But recent trend, I mean, you look at every data coming out of China, it looks like even 7% is going to be challenging. While the official line on the currency devaluation has been that it is in line with their longer term strategy of making renminbi more market oriented, but could also be due to the pressure they are witnessing on the export side and to prop up the economy. So I think some of those events will overwhelm in terms of the global sentiments, the movement in the commodities market, and also the US Fed decision. The positive aspect of that, one, that the fall in commodity prices improves our macro picture very dramatically, and second is that India relatively is looking a lot more better to global investors despite the valuations having risen. When you look around the world, I mean, whether in Europe, most of the other developed markets, look at the recent data from Japan, what is happening in China, the impact on all the commodity producers, and increasingly India looks relatively far better with the improved macro, with better political leadership, with better policy environment, and I think the corporate profitability at bottom, which is likely to improve substantially over the next couple of years. So from that perspective, I think India looks better, but all these events globally are going to affect us a little bit. And I think there's huge amount of money in the emerging market equity and bond funds, and those emerging markets, the indices have not been doing well, and I think that would have some impact on India. But I think allocation to India on a relative basis would go up, but if there are redemptions from emerging market equity, the fund manager has to sell.
Are local investors likely to panic, Navneet? I mean, let's just talk about flows into equity mutual funds, which have picked up and have remained steady now for many months. Do you expect that to stay solid?
So our view has been for last several months, in fact, a couple of quarters before the flow started, has been that I think we are on the cusp of a very, very big trend where the domestic investors, both because of the conviction that overall macro environment, policy environment is looking positive, over the next several years, equity market is likely to deliver good returns. So that's the conviction. And the compulsion is that the other asset classes are not looking good. So a combination of these two factors, I think, will lead to higher allocation towards equities. One of the very important things that's happening in the economy is I think there's a structural decline in consumer price inflation. Keeping the real rates positive will not only spur the higher savings, but will also ensure that a larger part of that savings go to the financial assets, unlike the physical assets. And with some of the recent government measures to improve the overall financialization of the asset markets, I think that will go a long way in ensuring that more amount of domestic money flow into the equity market. On top of that, the recent historic decision by the government to allow pension funds to provident funds to put money in the equity market, I think some of these measures will go a long way in ensuring that the domestic savings flow to the equity market. So this is a structural trend. We may have 1 or 2 months higher or lower number compared to the trend line of last 18 months, but I think structurally I still believe that the overall allocation of money from domestic investors would substantially increase over the next several years.
Okay, fair enough. Let me get as the Chief Investment Officer, Navneet, let me ask you, where are you putting the new money that you're getting from investors? Which sectors are you deploying that money into? Where are you most bullish? Just provide us the broad flavor, and then we can sort of go from there.
So the overall investment universe for us has expanded quite a bit, and there are lots of new opportunities emerging. We are looking at a cyclical recovery in the investment cycle going forward, driven by the higher government spending. Private capex will happen at a later stage, but the government spending, both from the central government and the state governments, and particularly sectors like railways, roads, where there is a lot of traction, defense, I think procurement is likely to happen. I think all of these are going to lead to a revival in the investment cycle. So the whole industrial space, when I say industrial, it means the capital goods, engineering, construction, that looks interesting. There's also opportunity in the manufacturing exports. So light engineering, chemicals is another very interesting space to look at. Apart from that, the overall, as I mentioned earlier, the fall in the CPI, I think the savings that the consumer has got because the commodity prices have been lower will get split between some amount of savings and some amount of discretionary spending. And I think overall aspirational consumption is likely to go. So overall discretionary, consumer discretionary, the auto ancillaries also look interesting. So these are some of the spaces. Apart from that, I think more one needs to look at stock specific rather than from a top-down sectoral views. So some of the sectors like metals, global commodities, I think we have been negative for some time, but at some point in time, of course, the prices would reflect all the distress which is there in the global markets. But by and large, I think our focus is a lot more on bottom-up stock picking rather than a top-down sectoral call.
Okay, all right. Do you think the bulk of the commodity expansion is sort of the sort of commodity deflation-led margin improvement is behind us, Navneet, for domestic companies?
No, I think it's just the beginning. No. My view is that I think this is just beginning. So I think we haven't seen the operating leverage fully playing out as the economy recovers, as we have higher growth going forward. And I think on the margin expansion, you picked up the raw material prices. I don't think we have seen the full impact. The last quarter, I think, is just a beginning. Structurally, the cost pressures for corporate India is receding. So we have seen the negative aspect of it in terms of declining profitability for the commodity producers in last couple of quarters, and they are responsible for one of the major reasons of the behind the corporate profitability decline. But the positive aspect in terms of margin expansion has just begun, and it's not only the raw materials. I think even the wages are stagnating. I think probably the wage pressures which we have seen last several years, the rentals the way they were going up, the interest cost, all kinds of cost pressures are receding. And with the better use of technology, logistics, the ease of doing business, I think if you all put together, I think the margin expansion story for some of the companies, some of the industries could be very interesting.
The point is that in the first quarter has shown that domestic companies, right, businesses serving consumers, have been able to hold on to the benefits of margin improvement because of input price deflation and not pass it on. Because EBITDA margins have surprised, even though revenues broadly for domestic companies has disappointed. They're better than last quarter, but disappointed still. But margins, no, it has surprised positively. So while commodities remaining weak will show up in better margins for companies, will they be able to hold on to it? Continue to sort of hold on to it. That's the point, Navneet.
So that depends on the competitive intensity of each industry. I think those companies who've got the franchise, a good franchise in place and have the pricing power, I think they would be able to retain a good part of the decline in the overall cost structure. But of course, I think at the end of the day, there would be some competitive pressure. Some of it will get returned to the customer and consumer. But keep in mind, this will also increase the spending at the consumer level. So I think it will reflect in both ways. The consumer will have the money of, the spending more. And so some amount of premiumization. So people going up the value chain, somebody moving from biscuits to cookies, or let's say if you are using a shampoo or soap or whatever, you're just going up the value chain. I think that could be another aspect of it which should not be neglected.
Okay, all right, fair enough. Navneet, so domestic company-wise, could you just drill down to sectors, subsectors really? Tell us what should one focus on, where is there lesser competitive intensity, scope for margin improvement, hence continued profit profile?
So I mentioned about some of the sectors that we like. I think the overall consumer discretionary, I think some of the manufacturing exports. I think the government has tremendous focus on the agriculture sector, how to improve the productivity of that sector for next several years. I think there would be some companies that will benefit from that because of the sheer opportunity in that sector. There would be opportunity, as I mentioned, I think mainly in the whole industrial space, the capital goods, engineering, construction. My sense is that in next couple of years, in terms of overall infrastructure build-up in India, I think India will surprise positively. And it's a very, very big trend because we have seen the challenges in last 5 and 7 years. It's very difficult for people to digest that what can happen in next 5 and 7 years with the commitment that the government has got. A large part of the decline in the oil prices have been kept by, good part of the decline in the crude oil prices have been kept by the government in terms of cutting the subsidies. And with the direct benefit transfer and some of the other measures, I think in terms of spending on the capex side from the government is going to increase substantially, and that will reflect in the revival of the investment cycle in couple of quarters time. And I think that's going to be a very big trend. And unlike the last time, to complete the story, unlike the last time when there was I would say extreme competitive intensity in terms of grabbing the orders, I think this time the companies would be relatively more cautious, ensuring that the working capital cycle doesn't go out of control in terms of there are decent margins to be made in that business. And I think the whole structure of that business can change very dramatically next several years.
All right. So you got a specific focus on industrials, capital goods, engineering. You're saying it will be difficult for people to envisage what can happen there. Again, it's a very broad, although you've identified, say, two areas there.
In the consumption, so...
No, I'll get to consumption in a bit, but could you be a little more specific as you can? Which areas, which subsectors, which subsectors? are you most bullish on when we talk
So I
about
think
industrials?
two or three larger trend you look at. I mentioned about the premiumization, the aspirational consumption, so opportunity both at the top end of the consumer as well as at the bottom of the pyramid. I think that the consumer preferences are changing. The technology is making it easier to reach out to the right consumer. They are becoming a lot more conscious in terms of what they are buying. The preferences are changing, and I think that's leading to a lot of opportunities to new set of players. Look at some of the recent IPOs and the several other IPOs which are likely to be lined up for next several quarters. I think there will be a new set of companies who would probably position themselves to take advantage of the opportunity which is emerging in the whole consumption space as well.
Okay, all right. Fair enough. I was actually asking you to be as specific as possible as far as industrials go. Where is the maximum sort of impact going to show up? Which specific areas do you think is the maximum impact going to show up? Because it's a pretty vast
So of
space.
course, I mean, if you look at the whole, there's very vast space. But unlike the last cycle, I think the one thing that one needs to keep in mind is the companies that have got have better operating leverage and companies that have the ability to build their order books without really straining the balance sheet and who got the capability. So those who got better execution capability, those who have kept their balance sheet intact in a position that next couple of years when the large opportunity is emerging, they would be in a position to capitalize on that. I think those would be bigger, and it's a vast space. So look at whether somebody is in forging, abrasives, compressors, gears. I mean, all kinds of companies in different kinds of electrical, mechanical, in the engineering space, in the construction space. I think the activity in India for next several years, I think that opportunity coupled with the manufacturing exports, as we become more competitive, we acquire scale and companies invest. I think that there's huge opportunity in the whole space.
Right. The thing is, if you look at some of the better companies across some of these areas, I know you can't talk about specific stocks, you can't name names, but stocks are already up many times over the last 1.5 odd years or so. Should one at all look at some of the, that part of the market in this sector which has not done very well, where there is that much operating leverage is not there, maybe there are some balance sheet issues, companies with not a very bad past but slightly muddy past. Should one do that? Because there you'd be able to find stocks which are already not, which are still reasonable in terms of price appreciation. They're not up 10 times basically. Should one do that at all or no?
Yeah. I think so. So I think some of them would survive, but at the same time, several of them will probably go belly up. I'm using a very, very strong word. So some of them will survive. I think overall, if you look at the EV, I mean, you look at the overall enterprise value and see that in some of the companies, the debt part is like just too big while the equity value has come down significantly. I think those companies where the assets are also good quality and not generating cash flows today, but with some changes in the government policies, for example, we have seen in the mining with some of those stalled projects coming back on track. If they are able to manage that, if they can become a little asset light, I think some of those may offer some value, but that's a little difficult game. Easier said than done in terms of where the companies have got huge amount of debt, and then you look at the overall EV where the equation is going to change, where with higher equity and lower debt, because they would be able to generate cash flows, sell some assets, and then generate some cash and then increase the equity value. But yeah, I mean, there could be big gainers from that, but I think that's a difficult game.
Okay, that's a consumer staples you're staying away from, right?
Yeah, but more the valuation issue in terms of the relative to the growth prospects. Of course, I mean, some of these are great companies in terms of cash flows, in terms of balance sheet, in terms of the brand franchise and all. But it's a relative valuation call where you believe that discretionary spending, the consumer discretionary space looks better than the staples.
You said agri. Now, again, a big space with companies doing all kinds of things. What specifically? Could you narrow it down a little bit?
So in the listed space, very few are available. So of course the agri-chemicals is one, and there is opportunity not only from the domestic market but also from the global market. Some of the companies have done well, and overall I think the agriculture, the whole spending on from the government side on irrigation, on improving the productivity of agriculture is going to go up. But as I said that not many plays in the listed space, but there are few, and then they look interesting.
Okay, fair enough. So basically agri-chemicals, right? Not seed companies that much.
Yeah, I mean, see, overall agri space, but then you have to look at the individual names. Can't be too specific.
Okay, fair enough. We've not spoken about IT or pharma. Any reasons?
So last couple of years they've done well over a longer period. Even when the domestic macro was challenging, they also got the support from a weaker rupee and the opportunity in the global market. Some of the companies, I think both in the IT as well as pharma, could do well in that environment. But as the growth becomes more dispersed, when you get opportunities even from the domestic cyclicals and all, then the relative premium that has been enjoyed by those sectors will surely will have to go down. Also that I think both in terms of the IT as well as pharma, I think there are some very big changes. There are paradigm shift, I think, if I can use that word, I think, happening in the technology space. So the whole opportunity in the digital side, in the SMAC, the social media, mobility, analytics, and the cloud, there would be different set of winners going forward. And the same thing in the pharma, so the biosimilars and some of the other developments that are happening in the pharmaceutical space. So you have to be careful in terms of picking up the individual stock rather than taking a broad sector call there.
Right. Okay, public sector banks now, have they become investable from a fund perspective? I mean, in equity diversified portfolios, I mean, not a financial services fund, but for a broad swath of equity diversified portfolios, are PSU banks now investable?
So the overall governance reforms, whatever we have heard over the last couple of weeks, I think are very positive. Structurally, they can change a lot of things for public sector banks, and markets have been enthused by some of those announcements. While the overall issues pertaining to asset quality, which has been keeping these stocks under pressure, I think the concerns remain on that front, but otherwise I think the incremental governance reforms are very positive for that space, and the valuation gap which has been there between the private sector and public sector bank has started shrinking. So we own one or two top quality names from the public sector space.
Okay, got that. Thank you very much, Navneet. Appreciate you joining us with that perspective. Good getting that from you. Thank you indeed. Navneet Munot with SBI Mutual Fund. He's the Chief Investment Officer at SBI MF. Let's just take a quick break here. We'll come back in 2 minutes.